As we look at our next topic in personal finance and the banking budget time value of money unit, we're going to take a look at banks. Our first question that we ask is, how do banks make money? How do banks start? And, where does the money come from? When you get to economics, we'll talk about banks starting up as a corporation where they will either have individual people invest in the bank to create a bank, or they will sell stock in a bank. And that's one way they get money, a little bit beyond the scope of what we're dealing with here. But in general, banks are going to make money by, one, accepting deposits from customers. And as they accept deposits from customers, they have to give those customers that money back. In turn, they're going to borrow that money out. Banks are going to keep a certain amount on hand, but there's a portion of it they're going to borrow out to customers in the form of some type of a loan. Car loan, home loan, loan for a boat, something of that nature. They're going to give the people who are depositing money, checking accounts, saving accounts, CDs, money markets, whatever, anywhere from 0.5% all the way up to maybe 2.5% in interest. In turn, they're going to charge maybe 4 or 5% interest on a mortgage loan, maybe 7-8% on a car loan. And the gap between those two, that interest, is where they're going to find money to both operate the company and make a profit. When we look at banking in the early 1900s, it was the ability of that bank to protect the money and the ability of that bank to give their customers back their money, the deposits, or being able to collect from the loans that kept those banks up and running. There was no safety net. There was no catch or insurance of any nature. So if the bank had problems, you were kind of out of luck. If we're talking, say, 1920s, roaring 20s, life is really good for most, not everybody, but for most, and you are making loans. There aren't rules on who you can make loans to and for what reasons. You can make a loan to someone because they want to take that money and invest it in the stock market. And through the roaring 20s, people were doing that and making a decent amount of money doing that. Or, you give it out to farmers for equipment or crop or to buy land, or people would buy homes, or banks themselves would invest some money in the stock market. So not a lot of rules, kind of the old Wild West, if you will, from a financial standpoint. And when the Dust Bowl happened, when the Great Depression happened, all of a sudden values of stocks go down, crops aren't harvested and sold, so those loans are not repaid. Banks would struggle because you'd have depositors saying, boy, I just got laid off from my job. It's a good thing I got a bunch of money saved in my savings account. They go to the bank and the bank says, well, we don't have that money. That money was borrowed out. There's no safety net. They're not paying us back, meaning the loans are not being paid back, so I don't have money to give you. And many of the banks shut down. In the late 1920s, early 1930s, post-Great Depression, FDR is president and comes up with a lot of ideas through him and or his administration. They come up with things like the Securities and Exchange Commission, kind of the financial police, if you will, for the stock market and things of that nature. But they also come up with deposit insurance. That's the big key. That's the difference between banking pre-Great Depression and banking post-Great Depression. We now have insurance. Depositor money is protected. Banks are now required to purchase insurance to protect depositor money. Each person's account, as determined by their Social Security number, will be protected from $1 all the way up to $250,000. That number has gone up in the last 20 years. It used to be $100,000, but now it is up to $250,000 per Social Security number. The first type of deposit insurance is FDIC. That is what most people will use when you're dealing with a commercial bank, your Kensington Bank, your State Bank of Cokato, your Wells Fargos, your First Nationals, and also your savings banks. They're going to use FDIC for their insurance protection. The other two, the SAIF and the NCUSIF, they happen, but they are not they work for saving and loan associations and credit unions. I would argue most people are going to use commercial banks for their banking. So we look at what is the brick and mortar building that you bring your money to keep it safe. Put it in a savings account, put it in a safety deposit box. Maybe you're going there to get a checkbook or to borrow money. So 5 main banks that are operating that we should know about. Commercial bank, credit union, saving and loan association, mutual savings bank, and an investment bank. The first is a commercial bank. It's the one that most of our average consumers would use. It's a financial institution that serves both individuals and businesses. You go there to get loans, savings accounts, checking accounts. Could be consumer or business loans. You may get investment services in there as well. Maybe you're going there to get a safety deposit box. Maybe your bank has a title company, so when you close on your home, meaning you sit down with the people who are going to buy your home, you fill out the paperwork, or the opposite end, maybe you're the buyer of the home. There's legal paperwork to transfer the title from the first owner to the second owner. Inside that bank, they may have those services. Other banks may not. So it's definitely something you got to look into before you go do business with the bank. It's more than just, well, can they give me a checkbook or not? Some banks will have insurance services as well inside the bank. Others, again, completely separate. Most of your banks in the U.S. are going to be commercial banks that average customers are going to deal with. To operate legally, they need to have either a license or a charter. Now, that charter can come from the federal government, which is a little bit more extensive and a little bit more expensive. But in turn, you can operate in more than one state or maybe even more than one country. If you're looking to get your charter to operate from the state government, you're bound by just those state laws, so in turn you can only operate in that particular state. Some examples, I don't think we would quiz you on these examples, but to get a flavor of kind of who is a commercial bank, it's not just our little, First National, State Bank, or Cokato banks. We got Wells Fargo, Bank of America, Citibank. These are all accepting customer deposits and making loans. Some are very large, some are small. Second type of brick and mortar building we'll call a bank is a credit union. The difference between credit unions and commercial banks are a couple. One, credit unions are member-owned institutions. If I have a savings account at Kensington Bank, I don't necessarily own a piece of Kensington Bank. I'm a customer there. Being a teacher, there is a Teachers Federal Credit Union. I think it's in Golden Valley, Minnesota. Members who are teachers are small, very, very small owners in that institution. Okay? They are often labor unions or churches or certain organizations that will put together a credit union. They have some nonprofit tax status, so that's why they're able to offer better rates on their savings and charge a little bit less on their loans, because they're not making a profit. That's not the goal of their institution. You have to be a member of that institution, that labor union, to be able to bank at their credit union. So teachers have a credit union. You have to be a teacher or the spouse of a teacher. If it's the, airline union, Boeing Employees Credit Union, you need to be a Boeing employee, whether that be a pilot or a baggage handler or a steward or a stewardess, maybe a mechanic. But if you're, Brian Clement, who is not an airline employee, I can't go to the Boeing Employees Credit Union and say, hey, I'd like a savings account. It doesn't work that way. Credit unions are there for their members for personal things, personal loans, savings accounts, checking accounts. They're not in the business of making business loans. Those first two are the two that most average consumers would use. The next three are out there. They're types of banks, but they're more specialized in who they deal with and what they deal with. Next up, we have an investment bank. An investment bank is for companies and governments to either help them buy and or sell stock. When a company decides to start up for the very first time, Facebook decides to have what's called an IPO, initial public offering. they would go to an investment bank like a Goldman Sachs, a Morgan Stanley, to help finance those very, very large transactions. Looking at some corporate mergers, companies that decide to combine forces. You look at the grocery store chain Lund's and the grocery store chain Byerly's. They were two separate companies, and now they have merged to be one company called Lund's and Byerly's. That's something that's fairly extensive, probably a little bit more than your average commercial bank would handle. When we look from an acquisition standpoint, many years ago, Minnesota had Northwest Airlines as an airline company that was flying here. They got bought out or acquired by Delta. So now if you're flying in Minnesota, Delta is one of the main airplane carriers in Minnesota. But to make that happen, they just didn't go to like State Bank of Cokato to make that happen. They went to a very large bank dealing in those specialized kind of services. Saving and Loan Association is our fourth type of bank. Their job, they specialize in lending money to consumers to buy homes. Majority of the home loans are done through the Saving and Loan Association. They may also deal with commercial or business mortgages. In the Cokato area, when Kevney drugstore shut down the doors, they had some office space. That office space may have been sold to other businesses. Right now, Snap Fitness is in part of that. They could have, I'm not saying they did, but they could have gone to a saving and loan association because a commercial mortgage is something that they're buying. Maybe they're leasing it. I honestly don't know, but they could have gone to an S&L to get that. If you look at like a Holt Motors, maybe they would go to Ford and buy these vehicles, or Kingston Auto would go buy lots of vehicles. This isn't Brian Clement looking for a $10,000 truck. This is an auto dealer looking to finance the buying of more cars so they can turn around and sell those cars. So that's where our Saving and Loan Association comes in. And our last kind of brick and mortar building we call a bank is called a mutual savings bank. These were originally designed to serve low-income individuals. They're mostly started on the East Coast, your Mid-Atlantic, your Northeast parts of the United States. They're more of a volume dealer. They are charging a little bit less in interest on loans. They're paying just a little bit higher interest on deposits because, again, they're looking for lots of clients who don't necessarily have tons of money, providing services for the low-income individuals. They're not the investment bank looking at high-dollar, big-ticket items. And those would be our 5 types of banks: commercial bank, credit union, investment bank, saving and loan association, and a mutual savings bank.